Hi, everyone. I'm Maggie Lake, and I'm here with Russell Clark, author of Capital Flows and Asset Markets Substack. Hey, Russell, how are you?
I'm good, thanks.
Uh, so I'm really curious to get your thoughts on what's going on. So thanks for doing this live, because I think a lot of people are also trying to figure out what's happening in the markets. And we spoke in January, and after our conversation, we were, the big takeaway was that there was a global paradigm shift that you were worried was going to blow up the bond market. How that sounds like very, very accurate description of what was happening at least yesterday morning. So just walk me through what do you make of the last couple of days? What is your takeaway here?
So I've had two different observations about the bond market, and they're slightly different interpretations, and they're not mutually exclusive. One's more short term, and one is longer term. The short term one, which I've written about, is one of the reforms we did after the global financial crisis is we moved clearinghouses to the center of financial markets. And it's a reform I've criticized for a long time. The problem I have with that is the clearinghouses have no skin in the game, and so they tend to price risk aggressively. So when you get a shock, they suddenly go, "Oh, we've priced things too aggressively." And they raise margins and basically get everyone to put in cash to offset their positions. And so, like with the bond markets, when there's a sell-off, they go, "Oh, actually, we've mispriced this. Everyone needs to give us more cash." Then people are forced to sell more, and we get that sort of sell-off in bonds that we see. And this is something we saw back with the UK under trusts and other places. And it's one of the problems I have with the clearinghouse reform. Clearinghouses price risk badly, in my view.
Mhm.
The other one, which I've just published about, is that I think if we look at what Trump, I think, was trying to achieve with his Liberation Day tariffs, and also I think the deal with OPEC. I think he was trying to achieve two things. One was lower oil prices, and he did that very well. Oil's down nearly $20 from where it was in January, so it's very bullish for US typically. And I think he wanted to get bond yields down there. I think he wanted to get the Fed to cut rates. He wants to get interest rates lower so he can get growth going, get the budget more in balance. And here we've seen the opposite. We've actually saw the 30-year sell off, and in fact, it spiked to 5%. I don't think it's a coincidence. At the time it spiked to 5% was also the time when we saw Trump's hit the pause button on tariffs because his strategy wasn't working. Putting all these tariffs on, telling people, "Hey, this is how it's going to be from now on." It should have, in the old days being like 5 years ago, whatever. And we should have seen, depending on the day, but we should have seen Treasury yields fall as people went, "Oh, we need to get protection. We need to be in a safe asset." And instead, we saw treasuries, long-dated treasuries, act like the equity market. And I think the reason for that a little bit is there's two different reasons. One, the problem with the tariff policy, and I've been talking about this for a while, is the reason the US runs a trade deficit with everyone is because everyone else needs to run a trade surplus. Otherwise, they've always suffered a financial crisis. So the countries that want to be stable, like Japan or Germany or Switzerland, they run surpluses. So they always have excess dollars so they can easily pay off anything they need. Now, as soon as you say to these countries, "You know what? You can't have these trade surpluses anymore," they don't need to put their money back into the US Treasury market. So what I'm trying to say is I feel like the tariff policy is going to secure the golden goose of very low interest rates relative to US growth. It's better from the last 40 years. If you look at what happened with Kissinger and the petrodollar and all these things, he made this agreement where instead of buying gold, everyone buys treasuries as a foreign reserve, and then the system can grow endlessly. And it has been a super successful policy. But by getting rid of the possibility of generating a trade surplus and then reinvesting that back into US treasuries, he's sort of breaking that system apart. And that was always a fear for me with the way Trump was talking about tariffs and trying to get to neutral trade position with every nation. If that happened, then no one would have excess dollars to buy treasuries with. Now, of course, for the US, we're running a balanced budget. That wouldn't be a problem. I know there's the idea that maybe tariff revenues could get that, maybe DOGE could get things into place. The tariff one's very tricky. We'll have to actually see if it works in practice and how much money it actually raises. The problem with DOGE, and I like the idea in principle, but it's a very unserious proposition when you go and fire IRS agents, because, when Germany came in to help sort out the Greek budget problem, they weren't firing tax collectors. They were hiring more of them. Do you get what I'm saying?
Yeah.
And so, I feel like a lot of different things have come through. And so I think the nature of markets has changed, where I would probably say we're at the beginning of the market sort of saying the US Treasury is not really a safe asset anymore. It's not a reserve asset. And that's a problem, because if you don't have to own it, it's very unattractive at the yields that it is, given where US spending plans and other things are. And I think that's a problem. And so the US has still almost become like an emerging market, where its bonds, currencies, and equities all move together. And I was an emerging market fund manager for a long before I was a global fund manager. And that was always how you used to. Basically, I would get the emerging market currency right, and then you get equities and bonds in that currency right. The US used to be the opposite. If equity is weak, bonds would be strong. But what we've seen over the last few days is bonds and equities are moving together, positively correlated. So I've talked a bit, so I'll let you ask some questions.
Yeah, and there's a lot of important stuff in there. So do you buy this idea? First of all, is that baked in? Is there a way to reverse this? Is that a result of the tariff policy, or is that a shift that's happening anyway? If the Trump administration changes gears, that can be rectified.
So I think it was already underway. And I think it happened. The big shift for me happened when the reserve assets of Russia were sort of frozen when they invaded Ukraine. And so, if you're running a government and you think there at some possible time in the possible future you may disagree with US policy, right? There's a chance that those reserve assets then get frozen. So what we've seen, I've talked about this a few times, is that if you look at, it's always difficult. I realize when you get to 50, you're old enough to understand how markets work, but you sort of lack the energy to do anything about it. It's like, I think you'll just, oh God, more of this. Let's go retire and sit on the beach or something. And then, luckily, I'm still got a bit of energy. But if you look at the world that sort of came into, we've gotten used to since, I said, 1990s, 2000. Before 1990s, 2000, the idea of treasuries as a foreign reserve asset was not really a big deal. It was pretty small. You still had gold was sort of lurking out there, like people going against gold. And the idea of like sovereign wealth funds was also almost unknown. If you think about it, it was basically, why would you have these things? Why would a government keep just saving these assets and not spending them or pushing up workers' salaries or doing whatever? It was really this Washington consensus that you need to keep your labor market competitive. You need to be open to capital, do all these things. And this created these huge pools of capital that we used to see. And I would say the world, and what we can actually see with hard data, is foreign reserves in these sort of government-controlled agencies are now starting to fall, because government is going, well, we can stick it in a treasury, but we might not get our treasury back. Why don't we just spend it on our domestic economy instead? And what you're starting to see in bond markets everywhere is this higher and higher yields. And I think the one for me, and I always talk about this, is first thing I ever do every morning is look at the JGB market. Because for me, the JG market, you'll remember this, Maggie, back in the 90s, everyone wanted to short JGBs, right? Because they said inflation is coming, it's a disaster. When that didn't happen, then people went, oh, okay, but Japan's going to be deflationary forever. And now they're all bullish yen and JGBs. But actually, what we've seen is a very steep and prolonged bear market in JGBs. And we saw a new high at the long end today. And so for me, like Japanese investors who are big financiers of the US, now look at the S&P with a yield of like 1.5%. They look at treasuries, yielding four and a bit. It's moving around so much. I'm not even sure how much the 10 years
I
yielding
know
anymore.
it's
But
I mean
yielding.
that in itself, the moves we've seen in the treasury market have been extraordinary. I mean, you're not used to.
Yeah, so getting 4.3 at the 10-year, but actually the problem I think really long is at the 30-year, because that's more of a sensible comparison to equities. So you're getting like 4.7 at the long end for the US Treasury, but that's only a 2% pickup for a Japanese investor. And then if they think the dollar is going to be weak, and it has been weak in some currencies, you sort of gain in this position where the US just looks unattractive. And then the problem is the policies make it more unattractive. Oh, we're not going to let you trade with us anymore. We're not going to, backstop your security anymore. You need to spend that. And so all this money is sort of going, well, actually, I might as well just stay at home and earn this high yield, relatively high yield. And that's the problem. And now, yeah, and that's the problem. Now, there is upside risk. Perhaps Trump is right that the tariffs can generate enough revenue. But against that, it probably means that inflation in the state's going to be, my guess is if the tariffs go in, structural inflation will be 6-7% for the next 10 years, would be my guess. With wages sort of going up at that rate. And so even then, even nearly 5% on a 30-year, it's probably not going to cut it for me. My base case is the long end goes to sort of 10%, which I know everyone thinks is crazy, but I'm old enough to remember when there were like 12, 13% short ends in the early 90s. And that was more typical. So I think that's where we're going.
10%. So yes, we've been there before, but the economy was built for higher interest rates. I mean, if we see 10% now, can the economy handle that? Do we just have recency bias that like, oh, it'll break everything. We can't possibly, everything's been sort of financialized and we can't have those higher rates.
Yes, I think what you'll see is what we've seen for the last few years is actually the economy does all right. Financial assets are a bit more tricky. And financial assets are a little bit more tricky because of the higher rates. What I really see is politicians are trying to rebalance the economy away from a really sort of trying to rebalance the income inequality that has really become a big part of the Western world. And in particular, I think one of the really activating issues for a lot of people has been the cost of housing, right? And I think what you're seeing is a lot of policies to try to reset that. So why I sort of think 10% is where we're going is what I think politicians are trying to do. Trump definitely in UK as well, even though we're the different types of political parties, is they're trying to push wages up like 7% annually, which over 10 years means a doubling. But they want house prices to sort of stay flattish, if that makes sense. So to achieve that, you need like a 3% real rate. So 7% inflation with 3% real rate gives you the 10% target I'm talking about. And that I think is where we're slowly but surely going, and we'll get an adjustment. So why I think real assets sort of struggle is if you've got 7% wage inflation, you definitely need a bit of asset destruction to keep inflation back towards that 2% target. That makes sense.
Yeah. Hey, everybody who's joined. It's not showing up on what Russell and I are looking at, but I can see you in a different window I have open. I want to get a couple questions in for folks who are cool enough to join. What do you think of gold TLT trade on different time frames? Nuxel is asking.
Yeah. So one of the things I have learned over time is people love targets and they love time frames. They like the idea that everything is stable. And I used to think that way. It doesn't work. All right. What I've learned to accept, especially in the time I've been out of the markets and doing my Substack and other stuff, is that we live in a profoundly political world. All right. And so if you understand what I've been saying previously, the politics over the last few years with Trump or Brexit or even just populists in Europe is that the income inequality has become an issue. Populism has risen. And so populism is about restoring balance to that sort of assets, wealth versus labor, if that makes sense. And so I think that continues until the politics turns the other way. And what we've really got a flavor for, and now I really understand why Thatcher and Reagan, they were voted in when I was a child, so I didn't really understand why it was such a revolution. You can imagine in the 70s, an era of tariffs and wages going up, and a lot of control on where you could put your money. It's suddenly, if you had a politician saying, hey, if you want to buy a cheap TV from China or a cheap car from Germany, you should. You don't have to buy locally. And consumers, you could see, would be like, great. If you follow what Trump's policies really imply, you have to buy an iPhone. You can't buy a cheap Chinese phone. And you're going to have to pay $2,000 for it, even though a decent Chinese phone now is $300. Now, at the moment, everyone's okay with that, but you could see that if that type of logic continues, where you have to buy, a GE-made television for $3,000, while when the Koreans are watching a Samsung TV that costs $300 and works better, you might start to get a bit hacked off about that. And be like, why am I not buying this? And we're not there yet. I think that political problem has to be solved first, and then the politics will change again. And politics can be, for me anyway, we're getting back to answering the question, the GLD, TLT, certainly until the midterms, I think Trump has a free hand to do whatever he wants. And he is committed to this. So I definitely see until the midterms, unless something really radical happens in the world, this will probably continue like this, where he announces a policy and then the bond market sells off, might freak out, hit the pause button a bit, but then the trend will still be the same. For anyone who's ever invested in emerging markets, somewhere like Turkey will give you a good flavor for this, where Erdogan is pro-growth, had a lot of growth. Every now and then the financial markets blow up and he'll do something like change the central banker or whatever. Assets will come down and then he just goes back to doing what he did before. And this is why I assume what happened in the States.
So it's really compelling to think about the United States as an emerging market, but I know there will be folks who say, first of all, we have a former macro hedge fund manager at Treasury, Buffett. So a lot of people are thinking somehow he's going to keep the wheels on and he understands the way markets work. And so he's going to work some magic to try to, at least there's a market voice in the White House. Maybe that's the best way to put it. And that there is liquidity and rule of law and people get voted out of office and, all of these reasons why it won't replicate an emerging market exactly. What do you think about that? Or how do
we do
respond to that?
Yeah, look, we do have a history. Back in the 70s, the US came off the gold standard, and under the Carter administration, it adopted a lot of sort of price rationing, price fixing type policies, which in the modern world we'd consider closer to an emerging market type policies. The 70s was also the era when New York was basically uninvestable and unlivable for most people. So you had this period of extreme stress within the US economy. And it was ultimately a great buying opportunity, but you had a reforming president come in with a mandate for change. And you had Volcker sticking short-term rates to 20% and keeping them there until the market was convinced of this new credibility, which is a very emerging market. If you ever, in the emerging market, I started out when like Argentina and Brazil were like devaluing in 2001, 2002. And it takes a lot to convince the market that you are sensible once you've lost that trust. That's the problem. I think, for me, definitely, it's tricky because, I was in New York a couple of weeks ago. I talked to people and, there was definitely a bit of denial that the US could be treated in a different way and the Treasury would always be a safe asset. And I just said, look, I think there's a risk here. And what we've seen is that where we would have expected the Treasury to rally, given a 20% sell-off in the S&P, it actually sold off, and it sold off in a disorderly manner. So I'm just telling you what the market is saying. This was my opinion. I thought it might happen, and that did happen. And so we have to sort of just accept what the market is telling you. You don't have to agree with me. I'm just saying I can see what's going on. The real problem is I just don't think there's a political mandate for austerity policies anywhere, particularly in the US. It's just a reality. The average working person is tired of taking the pain. So at the moment we have this fiscal situation where no one pays taxes and no one pays in, which seems to me a little bit unsustainable. Just my observation.
Yeah, just my mild observation.
It's,
So if the U.S. turns into an emerging market, what does that mean for the rest of the world? Because it's like I think that there's a thought now. I hear a lot of people saying diversify out of the U.S. The sort of era of the U.S. is over. Does everyone else thrive if the U.S. goes down? Did someone benefit from that, or does this cause a big global dislocation?
So the interesting thing in some ways is that so the 70s, which is known as sort of the stagflation era, generally people perceive that everywhere suffered in the same way as the States. But actually, if you look at somewhere like Switzerland, which runs a balanced budget, admittedly on other people's money, but still a balanced budget, has quite sensible policies. Back in the 70s, Swiss 10-year bond yields were only 4% when the US were at sort of 14. That makes sense. Well, there was a big spread because the money flowed to where it was being taken care of, if that makes sense. And weirdly, we're seeing the same thing happening again. So Swiss bond yields have collapsed to very low levels, and the Swiss franc is surging against the dollar, much like the 70s, which is why an emerging market comparison is more germane, if that makes sense. But here is where it's more interesting potentially, is that what we've seen over the last few years is that even as bond yields have risen globally, Chinese bond yields have actually stayed very low and moved lower. There's a number of reasons for this. They have a captured market. They don't have an open capital account. They control their banks, so it's easy for them to fund that domestically. But you are starting to see a huge gap open up between US government funding costs and Chinese funding costs. And depending on what they do in reaction to their tariffs that the US has placed on them and how other nations react to China, there is an opportunity perhaps for China to start supplanting the US as a central player. Certainly, a lot of Trump policies play into what Chinese policy has been aiming for a long time, which is a real irony of the whole Trump administration, is that they'd probably do a lot more damage to China if they ran a tight monetary policy and much higher interest rates, would probably cause China more damage than in the US. But politics is a funny thing that way.
A funny thing that they're doing exactly the thing that they, or there's a risk that you do exactly what you don't want to happen. Eric is asking, does the debasing of the bond market in some way create a perverse demand for dollars?
I don't see that, I'll be honest with you. I think the issue, this one is where it gets a bit more speculative, but I think, it's, like I said, the US has run this sort of attracted huge amounts of capital over the last few years, way more than what any model would have expected. If you look at things like their international investment position, it's very, very extended. And, part of that, I think, has to do with some taxation issues and other stuff. But, there's been a huge appetite for US assets. But I think in part that's driven by austerity programs being run out of Europe, and austerity programs being run out of Japan. But I think what the tariffs and we almost forget about, but what how US has treated Ukraine, which did have a explicit US security guarantee, which they gave when Ukraine gave up nuclear weapons in the 90s. The US said they would protect their regional, their sovereign integrity. It hasn't come through on that. It means that all these saving nations like Europe and Japan, who used to pour their money into the US, now sort of have to say, well, actually, we're going to have to build our own military. We need to remilitarize and we need to be more secure. And so that's why what I see is Europe and Japan is actually saying, well, we need that money. So we're going to keep it at home. And so compounding the problem is you used to get the Middle East, like OPEC, used to be big buyers of treasuries as well, particularly in their sovereign wealth funds. But with oil now back in the 60s and Saudi's got big spending plans, I just don't see who for foreigners, who is a natural buyer of treasuries now. I don't know who is. And like I said, I just don't think the program like DOGE and stuff is not going to cut enough spending from the US budget to make it balance. And so you start getting into like, for me, it's like where, what's going on here. I think the problem, of course, is all countries have problems now. There's a big deficit position, debt position for most countries. So people are just ending up putting their money into gold. And that was probably the most unusual thing about last year was I've never seen a market where gold is up 20-30% and the S&P is up 20-30%. That is not very typical. Do you know what I mean? I think we're sort of seeing that the gold market was correct and the US equity market was incorrect last year.
Do you think that if your forecast is for rates to go, or your sort of base cases, there's a real possibility that the long end or longer dated treasuries go to 10%? Do you expect would you expect to see some sort of financial engineering on the part of authorities here in the US to try to manipulate that lower? Would they allow that to naturally happen?
Yes, so I would be surprised if the Trump administration didn't try to do something. Like I say, I sort of look at Turkey as a good example, and Erdogan put a lot of pressure on the central bank to cut rates there, and the currency absolutely tanked, and then they relented. And I think that's really what gold and the long end of the bond market is telling you, is that they see the short end coming in, so people's like, okay, everything's going to be okay. But the bond market and the vigilantes are sort of saying, well, you're going to cut rates here, with this budget deficit. And, so the end keeps selling off. Now, if they come in and put in a yield curve control or try and cap the long end, I would expect gold to surge even more. And I would expect the dollar to really tank, because you then have really moved away from the free market principles that have made America great since its founding. Whenever the US has moved away, and you can see whenever you move away from free market principles, things go wrong. It's why free markets work. So as soon as you sort of start to say, well, no, you don't get to choose what the government has to pay, we're going to do it for you, you get into problems. And, of course, in periods of war and stuff, it makes sense. But even then, it's a confiscation of assets to pay for defense. So I would be, so that's why your subscriber's asking a GLD TLT trade. If TLT gets bought by the Fed, for example, to be pushed up, I would expect the GLD part of that trade to go absolutely nuts. The other thing I like about a trade is, like, if I was a foreign central bank, there's no way I'd be buying treasuries here. Like I said, you're not guaranteed to get the interest. I think even Trump's talked about not paying interest to China on its treasury holdings. So when you have like a bad borrower, basically US is a borrower. And when they start talking like that, why would you lend them any more money? You don't. You go put it somewhere else. And unfortunately, moving to a sort of gold-based financial system suits China more than it suits the US, which is why I think he's sort of killing the golden goose a little bit.
I think a lot of people there was really, yesterday's market action was incredible, but there was a lot of fear in the morning. I'm sure you saw it. We're getting all kinds calls from people about the Treasury market breaking. And then, of course, we had the announcement, and that really from Trump, and that grabbed all the headlines. But we had a decent 10-year auction, and some people thought, oh, okay, maybe all this concern about the bond market blowing up is not, it was a little bit hysterical. What do you make of that 10-year auction? And is that just a kind of blip? We're going to get good auctions, but the overall trend is still moving in the direction, or you're concerned it's moving in that direction? What do you think happened yesterday with that? Should people take some comfort from that?
I think, there was probably definitely, the problem is, okay, so I'm going to assume like the guys who, run the Treasury markets are guys like me around 50 who've seen a bunch of things. The problem you've got now is like, when I look at the way governments react, it's like, typically, they used to do austerity. Austerity was a big policy, and now I just don't see that happening. I can see how there probably was a lot of demand, maybe almost automatic demand from algorithms and other things. If you look at how the markets have traded over the last 30 years and say, oh, we should be buying treasuries now, and you certainly get that type of mentality. What I find really extraordinary, Maggie, I've talked about this a lot, is like, so back in 2014, I was very, very bullish US Treasuries when they were yielding like 4%. I went to the States and I said, look, China's going to blow up. It's deflationary. Emerging markets are going to blow up, deflationary. Treasuries will be fine. No one wanted to give me any money. Well, no one believed me, but they were willing to give me money. I said to them, why don't you just go buy the Treasury yourself? You don't need to pay me a 20% performance fee. They said, Russell, we think you're right, but everyone else hates bonds. So if you're wrong, I just get to fire you rather than I get fired. And I'm like, look, I'll take that. I'm willing to take your money to be that sort of firewall for you. And what I find extraordinary is, I think when when rates went to zero and everything like that, I think there was this mindset change to be like, oh, I don't need to look at the metrics behind bonds anymore. They're just always a buy. They'll always be safe. And I think what's happened is the politics has changed so much. Even if you look at the US, you had Trump, and then people thought, when Biden came in, we're going back to the old days. Biden didn't really roll back many of the financial policies of Trump. If anything, he probably accentuated some of them. And now we've got Trump again. Maybe we have Vance next, or Trump again. I don't know. But, like I said, until the politics changes, I feel like bonds are a bad place to be. And I think the market is telling you where it's safe and where isn't. So Japanese bonds, not safe. UK bonds, not safe. Swiss bonds, maybe safe. They look safe. I personally think Switzerland still looks interesting. It's going to be tough for them because they're very expensive. But, this is the problem with running a sensible government, is your exchange rate gets crushed to the upside and all your businesses then get destroyed. That's what happened to them in the 70s as well. So, I think we just go through this period where income inequality is shrunk, not, where assets will go sideways or fall in real terms, maybe not normal terms, in real terms, and wages go up until we get some sort of parity again and the politics shifts again. I don't see that happening very soon.
Listen, I'm already anticipating that this is so important, this conversation. I'm already anticipating there's a million questions, and I see some in here, folks, to ask you. But you've been covering this in your Substack at length. And like I said, when we talked in January, you literally, like, it could have been the headline for what happened yesterday. And so I think it's so important for people to hold this in their minds as they try to think about this. I want to ask you two questions before we go. One is this a U.S. only situation, or is this global? This idea that the politics controlling it, things have shifted, trying to address that inequality because basically just voters are demanding it. Is that specific to the U.S. or is this a global phenomenon, which to me means there's not that many places to hide?
So I think it is
havens.
Well, there are going to be positives to this as well. I often get accused of being a perma bear. I'm just like a realist, and I look at what's sort of happening. Some of the more interesting things that's happening, in my view, is if you look at so politics in Europe has become more unified than it ever has. So sort of like the pro-Trump guys in Eastern Europe are now sort of really trying to downplay their Trump ties massively, which is very understandable. You also, what you start to see is you used to have this sort of idea of like succession, smaller states succeeding within nations. So like the Catalonia from Spain, or maybe Scotland from the UK, or Quebec from Canada. All of those sort of successionist campaigns are dead in the water, like dead. No nation, if you like 2-3 million people, 10 million people, and you think you can go alone and be okay, gone. You look crazy, and voters know this. Voters aren't stupid. They always vote their best interests. So suddenly you have like a degree of unity that you haven't seen for a long time. It's like the old joke: if you want peace on Earth, we need to have a war with Mars. So you have a war with Mars.
Yeah.
We all you're my buddy. Okay,
movies. I think about this a lot.
That's true. 100% true. And so Trump, by becoming like a hate figure for the rest of the world, has really reunified it in a way that no one else probably could have done. It probably wasn't his intention per se, but that's what he's done. And so you could see some amazing things happen. So I wouldn't be, and I certainly, I've learned the hard way, never want to get too dogmatic in the way you think. I personally avoid dogmatic thinking. If you looked at me politically, when I was younger, I was very much to the right because I found the socialists and the communists too dogmatic in their thinking. But now when I look at the right, I'm like, you guys are crazy. So I haven't really moved, but the politics is moving around me. And as a general rule, as a life rule, if you're given two extreme views, the truth is going to be 100% in the middle, right? So the right-wing guys are probably right. Government is too big. There's too many regulations. But no taxation for large corporates. I'm not sure that's the right policy. And not defending nations you give a security guarantees. I don't know if that doesn't feel right to me. Do you know what I mean? And so that has been always the wonder and promise of democracy. We sort of stay in the middle, and maybe we have a loon in one side, and then we go and kick them out because it's like that doesn't work. And I think we're going to get to the right places. And I think what I'm trying to say to people is bear markets are not necessarily losing or winning. It's adjusting and getting back to harmony. And I think we are in this process of getting back to harmony. It's a very positive thing, not a negative thing. But you just need to be a bit more careful of how you put your money or where you put your money. That makes sense. It's not going to be the happy-go-lucky bull market we've had for the last 15 years.
I absolutely love that way of thinking about it, Russell. Thank you. You at least made me feel better. But I think that is a great framework to look at things through. And so then the last question is, I've had, and this always worries me. So in the crazy rally yesterday, which was crazy. I mean, that 12% on NASDAQ is extraordinary. People are seeing this and saying, okay, it's down again today, but this is a generational buying opportunity. And I'm not asking you to make a recommendation to people, right? But for younger people, and the comment was made by somebody who is, I'm going to say, around 30 years old. Should people, just in general, in terms of sort of level of caution, how do you think about that statement? Does it make sense if someone's 30 and thinking that way, or are we just in a new regime where you just have to be really careful about jumping into these kind of markets?
Let me put it in another way. So when I first went to Japan in 1991, which is the top of the Japanese bull market, I would say, anyone who lived through the 70s and 80s just knew that Japan was a place to get invested. There was a huge, and it was like the center. And then things started to go wrong. And again, I think it was political. Like it became so expensive and housing was so expensive, policy adjusted to like, we know what we need to sort of get rid of this a bit within the framework that existed at that time. So you ended up with 3 decades of stagnation. And I think, to be honest with you, I think the US is in that same sort of position again, where it gets so extended. As I tell everyone, whenever I go to Manhattan, it's this funny place where only the billionaires are happy and everyone else is sort of like struggling. It's feel like, I always meet a few billionaires when I'm there, and like everyone else, like, it's expensive, it's hard to save any money. And I feel that that's the adjustment we're making. And look, all I would say, unfortunately, is Buffett's so old now. I don't know if he'll be around for the bottom. But if Buffett's buying, you should be buying. If Buffett's selling, you should be selling. Is a rule I think most people would do well to follow. And he has been selling, and he's still got lots of cash. If he starts making comments like, "I'm going to come out and buy everything," then you should take a closer look at that. But I don't think he's saying that at the moment. He's probably looking at the long day of Treasury yields and saying, they still look more attractive than buying the S&P. That would be my observation. You're getting 4.7 on the 30 years. It's off today, so the curve is steepening. 4.7 at the 30 year, where you can get a 1.5% dividend yield on the S&P. Those dividends aren't guaranteed. If the tariffs go in, you would expect earnings to fall. You expect maybe dividends to get cut. I'm just saying, the numbers don't make sense. Just because you haven't seen a bear market doesn't mean they don't exist.
Yeah, I know. I think that there's a lot to be worried about. Russell, like I said, I have 1,000 more questions, and I'm sure everybody else. But yours a really good point. Like, who is the next Buffett? He was like he has that much credibility that when he would come in and say something, or he would come in and backstop in crisis, it was a game changer. And I wonder if anyone has any thoughts. We're not gonna don't post them here, but send them to Russell and see, nominate who you think would be the Buffett of the next generation. Because you're right, not clear how much longer we're going to have them.
Yeah, well, I think about Buffett a lot. He's a genius businessman, and he moved to the permanent capital structure at the right time. And this will actually be my last point because I got some calls after this. But I always used to. So when I was younger, I thought there was two types of investors that you could aspire to be. Most people aspire to be Buffett. My personal favorite was Soros. I found like his style more attractive to me, just because coming from Australia, living in Asia, and seeing the sort of bear markets we had back then, he was more attractive in style to me. But I thought they were two very different styles. And actually, what I've realized, and again, this sort of older thing, is that they were actually two sides of the same coin. So the Washington consensus that sees pro-capital, or the accumulation of capital, it sort of implied that you need to have constant crises to keep wages constant globally. So the Asian financial crisis was about overvalued wages. The Euro crisis was about overvalued wages in the peripheral of Europe versus Germany, for example. And most emerging market crises were like that. Crises are about getting costs down. And so Buffett was playing the same sort of trade, and like he was buying corporates because policies were intended to be very good for corporates and getting interest rates down and costs down. And Soros was playing in the same way, but in the more Schumpeterian, economically destructive way, if that makes sense. I still prefer the Buffett way of doing it, but what I realized is they weren't distinct. They were just two sides of American capitalism. So what do we do from now? And is there going to be another Buffett? I don't know. I'm very open-minded about these things. All I know is I would pay attention to bond markets would be my sort of leaving comment here.
And we will do that. And we will be reading your Substack in order to make sure that we are aligned in our thinking. Russell, fantastic conversation. Thank you so much. Super important, as I've been saying, to hear from folks with a lot of experience, and especially global view at a time like this when markets are moving insanely. So thank you so much. Appreciate it. Appreciate all of you who joined. Thanks so much. We'll see you again soon.
Thank you.
Thanks,
Take
Russell.
care.